The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. This is Larry Pesavento for TFNN, and I want to welcome you to a new week. And we're going to look at money today. I know everybody likes money, 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 money. So we're going to look at the currency markets. We've got a trade set up that is mother, God, and country. If you believe in repetition, if you believe that markets will do the same thing over and over again, if you believe in Fibonacci numbers, this is what we have for you today. We're going to look at the U.S. dollar first because it's on a monthly chart. You know, we've been in this big pennant for a long time where we had the double top at around 85, and we've backed off to the 786 retracement of the last swing at 80. And now what we've done is we've come up and we're testing some really key numbers this week and a couple of things that we need to go over. The dollar index, most of you probably know this, but 53% of the dollar index is the euro versus the U.S. dollar. And then if you add in the Japanese yen to the dollar, that'll cover more than 60% of the dollar index. So it's heavily weighted by those two cross rates. So those are the ones that I watch quite a bit because it affects the dollar index. I don't trade the dollar index. It's too thin, and it doesn't trade 24/7 like we get 5 days a week in the cross rates. So, but it is a good indicator, and they use it for a lot of calculations like inflation and things like that. So what we have happening now, I posted into Tiger TV the chart on the euro based on the weekly basis. And as you can see, since 2008, we've been going down for a considerable length of time. We've had 1, 2, 3, 4. This is the fifth lower high that we've had in the last 5 years. And each of them, of course, we've had a double bottom, between 2010 and 2012. But this last rally that we've had has stopped right at the 61% retracement at that 134 level. And we need to look at this from a pattern recognition standpoint because it's a trade that really sets up nicely. And if it's correct, you're not going to see the euro above, the 135 level. That's the way it looks to me as far as from a technical perspective. Now the next thing we do after going to the weekly is we want to walk down to the daily, and see what the daily is looking like. And as you can see, if you go into Tiger TV, you'll see that from the low we had in April to the high we had in April, that was an equal time move up. And we had the same thing happen in the euro between the May low and the high that we made on last Thursday. And that came in at a perfect 61% retracement, and that was also an ABCD, and that makes this a perfect Gartley sell signal with time and price being exactly equal. These are the kind you wait for if you have the patience, because everything is set up for the market to break, and the first profit objective on this would be well over $4,000. So you're risking about $600 or $700 to see if the market will make it to the that profit objective of potentially $3,000. But that's the pattern that we're seeing in the euro. But there's something else. We've got another little surprise that I think you'll maybe you'll enjoy it. I don't know, but I know what. I enjoy it, so that's what's important. If you'll give me a second here, it takes me a second to pull it up because it's a very large chart, and I'm hoping that it will show up well on Tiger TV. I know that it will, but it is a picture of the euro on a 4-hour chart going back over the last 6 weeks. And what it does, it shows this expanding triangle, 1, 2, 3, 4, 5, T6 pattern that Gartley talked about, and that also occurred at that 134 level. That's the level we hit on Thursday. And you can see that this has really got things set up because you're looking at it on the weekly, you're looking at it on the daily, and you're looking at it on the 4-hour chart. And if you went down on an hourly chart, you'd see the same thing. But the interesting thing about this chart is if you'll look at the how wave 1 was formed, where I have it circled there, you'll see that that also was completing a 5-wave reverse point wave pattern when it was making that high at the wave 1, and we had a big correction just on an hourly chart of well over $3,000 just on that particular leg. And the one we're looking at now has a potential to be, a huge difference in dollar amount. You're talking something that could be, far bigger than what you have on that first wave 1. So that's what we're looking at in the euro. It's down just a little bit today, not very much, which is not surprising because the market's been bullish for quite some time, and no one is really, making any any big any big deal about what's happening with euro because it's really pretty much unchanged. Now the next one we want to take a look at is the British pound on the daily chart. Now that's also included in the U.S. dollar index, and that is also approaching the 61% retracement. We actually hit that today at the 157.40 level, and we have a potential for an ABCD to go just a little bit higher, but this pattern is also completing. And again, you're looking at a currency versus U.S. dollar that has been in a bear market for quite some time, and we're having just its first major rally off of the February lows. That February low to the April high and then to the May low has completed this ABCD very close to where we are right now. So we're looking to be short the British pound and also the euro versus the U.S. dollar if, in fact, these patterns are going to work. The interesting thing about the British pound versus the U.S. dollar here is if you'll notice during 2012 it made a double top and then it made a triple top, and that was at the 786 coming off of the 2012 high. And so that was another indication that you were in downtrends because you couldn't break through those highs. No matter what it tried to do, it was unable to get above that 163 level, and it went from 163 down to 148 where it completed the big ABCD and the 1.27 expansion. So these are looking like the dollar is getting ready to have another leg up. That's what it looks like to me. It could only back off to a 786 of the previous low that we made last month. That was down at the 80 level. We're trading, 80, almost 81 in it right now. But the dollar has to break out above 85 in the dollar index, and that would really get it moving. By that time, the euro would be trading most probably somewhere in the 129 level. If in fact this is going to be the with a 129 level, if this is in fact the pound would be trading around the 152 level, if that were going to be the case, because we made those highs in that dollar index, in March and April, and so this is what we're working against at the present time. The thing that I think is important to remember here is that 5-wave pattern that we looked at in the euro. That's the one that made me so bearish on the stock market. In fact, I get emails from people saying, how can you be so, bearish when things look so good? Well, folks, I was bullish when things look really bad, so that news doesn't mean anything to me. I really don't follow it very much. That's the understatement of the year. I don't follow it at all. I watch what the news, how the reaction to the news is, but frankly, I don't pay any attention. I haven't seen an issue of the Wall Street Journal or Investors Business Daily in years, and I really literally mean that, years. And I don't need to. I mean, I'm just basically looking at what prices are doing. I don't have to worry about what the news is doing. The news is telling me what prices are doing. If prices are going up, there's more buyers. If prices are going down, there's more sellers. That's the bottom line of what we're looking at this particular junction, with technical analysis. Now, the next one we want to take a look at is the longer-term weekly chart. in the dollar versus the Japanese yen because it's very important because we hit the 382 off the 1998 high, and we sold off a great deal from that level. That was also a 50% move off of the 2007 high, and we've come down to a 382 retracement almost exactly to the 93 level, and now we're testing to see if this 93 level will hold in the Japanese yen versus the dollar. Now, there's a correlation between the Japanese yen and the Nikkei Dow, the Japanese stock market, and that correlation is better than 90%. If you overlay a chart of the Japanese yen currency and versus the dollar over the Nikkei, they're almost tick for tick. There'll be a little variation in swings, but they are very, very close. In other words, when one goes up, the other goes down. And we've had a pretty good bounce. We had a correction from 16,000 down to 12,000 in the Nikkei Dow, and we bounced back a little bit. So we're waiting to see if this rally that we're having is going to be a 3-day rally or a 2-day rally, 5-day rally. We don't know. We'll have to just let history tell us, what it's going to do. But that's what we're looking at with these currencies. We're at the proverbial moment of truth. I believe there's any ifs, ands, or buts from a technical standpoint, and that's what I'm looking at, because everything sets up together, and it makes it look like, we're going to have something really happening. The currencies are telling us when you look at the euro versus the U.S. dollar, since Sunday night that was Sunday night, 5 in the morning. Let me rephrase that. 3 in the morning, New York time, which is 8 o'clock London time, the spreads in the euro started to increase. They went from about 1 or 2 pips out to 3 to 5 pips, which I hadn't seen this happen for quite some time. That usually means that something big is going to happen. If that spread moves out to 8 or 10 pips, you can just about, make a small wager that volatility in the euro is going to, increase a great deal. And there's a possibility that this pattern that I'm looking at in the euro at the 134 is wrong, because if we see a print above 130, around 135 in the euro, then this pattern is certainly not working, because it's set up to do exactly what it should be doing, and that is, starting to drift a little bit lower. And if it doesn't do that, then you're dealing with something that is, a totally different ball game, and you don't want to get involved in a market that runs away, and that could be it. That would be a really collapse in the dollar, too, folks. That would mean the dollar index would go, far below the 79 level, and we're trading at 80, 75 right now, and that would mean that the yen would drop all the way back probably, to the 618 retracement at 86, or even potentially the 786 at 81, because if you look at the yen, back in 1994, it went from 79 to 149, and it was still in a monster bear market. We've got to take a little break here. When we come back, we're going to be talking about a market we've been watching for a long time that is starting to move.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX. The Art of Timing the Trade Charts has officially launched at TFNN. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind software, The Art of Timing the Trade Charts allows you to scan for Fibonacci formation setups, including Gartleys, butterflies, ABCs, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the market for stocks just beginning to form the trading patterns that many investors spend days, weeks, and even months searching to find. As part of our introductory pricing, we're offering licenses available at only $59 per month. We're so confident that you'll love this new outstanding piece of charting software that we'll even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Lock in your low price today by ordering your copy at TFNN.com.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks. Well, we've been waiting patiently. I think that's the understatement of the year. We've been way over a month. Actually, longer than that. Actually back in April, we first started to look at this. I posted the chart for December corn. That's new crop corn. That's the corn that was planted during the spring when the weather was getting a little wet and it was late getting in. But they're still expecting a very good crop. The thing that's important here is we were looking at the repetition of what happened during last June. On June 14th, the market in corn, December corn at that time, which was the old crop, now we're in the new crop, came in on the 14th of June, and it was a beautiful ABCD pattern, and the market went over $7,500 in the matter of the next 2.5 months during the drought of 2012. Then we had a lot of great patterns. We had a nice Gartley pattern in November. We had another 3-drive pattern. We've been waiting for this last one. The time is correct. We're right over the seasonal lows that we should be hitting. Today is the 17th. Last year's it came in on the 14th. We hit the exact number at $5.25.5 per bushel Sunday night in Sunday night trading, and it's tradable because it does a pretty good job of volume and everything, and so it did hit that number, and it's up well over $500 an ounce at that an ounce per bushel. I trade gold so often I trade everything in ounces. If corn ever gets to $5.25 an ounce, folks, there won't be any people on this planet because there will be no food. But anyway, at $5.25 a bushel, it's rallied over $650 a bushel in the last few hours. And the easiest way to look at that is if you were watching a 60-minute chart, it'll just take me a second to pull it up, and we will hopefully have it for you here. If not, I'll have it right after the break, and we'll be able to take a quick look at it. Nope, I can't get it. I got the wrong corn. I've got the new crop corn, and I don't want to put that in there. So if you'll bear with me here 1 second, I will get this to let you see what happened as far as the number that it hit overnight. It was just right at the exact spot, and it was really a beautiful pattern. And we've had a very significant rally in corn, since that time. And the rally should at least go up another $500 to $1,000. But at this point, you wouldn't be risking very much, and that's the bottom line. But we've been waiting for this for some time. Our good friend Rich Anderson at Anderson Capital Management was been on the show several times since we've started watching this pattern. And Sunday night we were chatting, and he said, "This is it." He said, "The fat lady's at the top of the orchestra getting ready to sing," and sure enough, this one worked. They don't always work. You get some that don't work as well as others, but this was one that at least started in the right direction. Whether it continues or not, we'll have to be able to see. But folks, let me explain something to you. The chart that you're looking at in corn is no different than the chart that we're looking at in the euro. It's simple geometry. It's simple mathematics. All you have to do is add, subtract, multiply, and divide, and draw a straight line. If you can do that, you're able to do pattern recognition, because that's all you're doing. You have an X and Y coordinate, correct? All right. You have a chart with a price and time, and then you connect the dots between the highs and the lows, and to see where the patterns are. And then once you've done that, you're pretty much in the ballpark of where you should be. That's the bottom line. And it's nothing mathematical. You're not looking at, differential calculus or, things like that the quants always look at. We're looking at something that is relatively simple. If you want something that really, set your mind working, you got to look at the new art of the charts that Tom O'Brien and David came out with, because it really does a good job at picking out the Gartleys for the 5,000 or so stocks and ETFs that it scans each day. I've seen some examples of it. I've seen examples when it works and when it doesn't work, and it is a really valuable tool. If you want something to help you to search for Gartleys, then this little charting package, which is only $60 a month, I believe, is really worth the price of admission in my estimation. We're going to take a little break here, and when I come back, I've got to talk about the state of my bearishness, because I've gotten more than several, about why I'm so bearish, and I don't want to go over each of the things, but I think it's necessary that since it's my show, I get to say pretty much what I want unless they cut me off, which is possible. But we are looking at some really nasty stuff on a global basis in Asia. That looks terrible. China looks horrible, and the break looks wonderful, which we're going to take right now. 877-927-6648.
Tom O'Brien's daily newsletter, Market Insights, gives you Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. With Market Insights, nothing is left to guessing. With the market at record levels, volatility is here, and now is a perfect time to take advantage of a 2-week free trial to Tom O'Brien's daily newsletter, Market Insights. As recently as March 26th, Tom advised his subscribers to liquidate their 4 short-term equity holdings, closing out all 4 positions for a combined 15.9% profit. And on April 1st, Tom advised his clients to sell their longer-term position in AIG warrants, locking in more than a 40% profit in just that one trade. If you'd like to see the kind of newsletter Tom O'Brien sends out to his subscribers each morning, then sign up for your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page of TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN. No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, we're back, folks, and I posted the chart of the Bradley model with the Dow Jones over it, and basically, it's my opinion, if we go below that 149, which is about 300 points from where we are right now in the Dow Jones, I think we're going to see an acceleration of a pretty strong magnitude. The VIX index is already starting, to give us indication that it wants to head towards the 20 level. We're having a little bit of a, setback in it today, which is normal because you went up and tested that 18 level again, and that's not unusual, but that's what we're watching. The next chart that I wanted to talk about, and someone asked me, how bearish, how bearish am I? Well, if you put it on a happiness scale, and I was to be looking at happiness, I would say that we would be looking at something. I'd be as happy as as flour would be at a baking convention, or something like that. I mean, it would be as happy as a witch in a broom factory, because this is just like it was in 2007. I don't think anything's changed. I don't know what's happened, economically as far as what these banks are doing. It just looks like, this banking index has just barely made a 382 retracement from the high back in 2007, whereas the S&P has actually taken out the high, from 2007. So I just believe that this pattern that we're looking at, this 5-point reverse point wave on the Dow Jones and the NASDAQ and the others that we're watching are just incredibly very, very bearish, and it makes you, it has to mean something economically, because even though the stock market is not about economics, it does follow usually what the economy is going to do. Sometimes it leads it, sometimes it lags it, but it's still very, very close, to what is, what is really happening there. There are some positive signs in the markets that I wanted to put the one for the NASDAQ because that goes well over 1 year, and it is a big three-drive pattern, with the first drive in March of 2012, and then we had another one in September 2012, and then the last one we had on June the 1st, which was a 1.618 expansion to the exact penny from the March to June low of 2012 to where we hit. This was a perfect 1.618, and that is a very important mathematical number, looking at these Fibonacci numbers. So all these patterns are correct. If we make new highs now in the Dow and the NASDAQ and the S&P, then I'll be found at McDonald's right behind the French fry section, flipping burgers. But I started there. Maybe that's where I end. I don't know, but we'll wait and see. When I first worked at my first McDonald's in Terre Haute, Indiana, in 1955, the actual cost of a hamburger, French fries, and a milkshake, either strawberry, chocolate, or vanilla, was 45 cents. We didn't have sales tax, but for 45 cents, you got a McDonald's hamburger and French fries and a milkshake. And not only that, but the sign on the McDonald's would show how many million were sold. At that time, it was 30 or 40 million. It was some ridiculously high number, and I think they're probably in the trillions now. They don't even show how many they've sold, but it's got to be, who knows. And someone asked the question, were they better then? Frankly, I thought they were because they were charbroiled better than they are now. Now they're put on a grill, and at least I thought they were. But I was just barely a teenager, so I really didn't know, and so I just gotten my driver's license, so I was more important about getting a car than anything else. The next chart that I wanted to show here, I get back to the markets here, is the cash S&P index, because that's a better indicator of what they were doing. Someone asked a comment about the meat for McDonald's. Folks, I got to tell you something here. I know McDonald's. Ray Kroc was actually a friend of my mother. She was in Ray Kroc's wedding, and so we did know Ray Kroc. I mean, he was in a different side of the tracks, but his wife and my mother were, friends. I mean, they actually knew each other, and from Chicago, and of course they moved to California. But McDonald's uses fantastic products, folks. Let me tell you, when they say meat, they're using meat. I knew a man named Lad Hitch out of Guayman, Oklahoma. I did his hedging when I was at Drexel for cattle, and believe me, they only used the very best for McDonald's beef. And boy, they had to be right strict on the percent fat that was in those hamburgers, or those beef patties were returned. And so it was very, very strict, and I'm sure they're the same way now because they have great quality control. Cleanliness, that's by store, I guess, but the overall company itself makes very, very good products. I don't think there's any, well, not in my mind, there's no doubt at all. Sarah and I travel all over the globe, and of course we have a McDonald's latte here and there, and occasionally a fillet of fish. But when you go to these foreign countries, the potatoes are the same, the beef is the same. When you're in Asia, you're getting Australian beef, but it's pretty much the same. It's pretty much the same taste. So just remember that McDonald's don't say that they're using things that are not good, because that's not right. They use good stuff. At least they did, and from what I can tell from my recent experience, I don't think there's any difference, but we'll see. That's just my soapbox for the day. Let's get back to this cash S&P, because we have a very nice trend line that started in February. That comes in at 159 on the cash S&P. We're trading at a little above that. We're in the 160 range right now, and so if we get below that, then we would be looking at that same bear market that we'll be looking at in the Dow Jones if we get below the 149 level. everybody is, not everybody, but there are a lot of people that are still very, very bullish, which there should be, and there's no reason to panic, which there should not be. But if we get below those lows we made in early June on this last, sell-off, then I really think this is going to start to accelerate, and I believe that the acceleration is going to come at the expense of the Treasury bond market, because that's the one that appears to be having the biggest problem. I need to put the VIX index up too, because I really think it tells a really good story. Basil has some really good things to talk about it, and there's a really strong probability that we're going to make that 20 level and possibly a whole lot higher. I believe we'll probably get in the 30 area before we get too far along. But we've had this 135 pattern where we have three higher bottoms. That's the same pattern that we had with the Japanese yen and the Nikkei Dow before they took off, and this is doing, pretty much the same thing. So we should have strong support in around 14 in the VIX index, and that's the number that I'm looking at if we get a pullback in the market. But frankly, it's a question of how much we're going to get. And today we're having a real strong reaction after the sell-off we've had over the last few days, and that's it. I want to bring into one of the stocks of the Dow that I think is important to look at, and that is General Electric. This used to be, it was the most widely held stock in the world at one time. It has certainly lost favor because it went from 43 down to $5.74 a share, and we rallied back to a 50% retracement of the high to low in 2007 down to where we are now. We've made a 50% retracement back at the 23 and change level. So that was one of the biggest stocks in the world. Another one that I follow, just to show you that the thing is, just overall, not everything has gone into new high grounds, and that is ExxonMobil. And there's two things on this chart that I think are very important, and one is that if you'll notice on the left side of the chart, where ExxonMobil, you're going to see that that 5-point reverse point wave. I've marked it there. 1, 2, 3, 4, and 5. That's that same pattern where wave 2 is exceeded by wave 3, and wave 4 exceeds wave 2, and then wave 5 exceeds wave 3, and that makes your 3 drive to a top pattern, and then you can see that the price of ExxonMobil, dropped in half. That's the same pattern that we're looking at with the euro on the 4-hour chart that we looked at. This is the same pattern that we're looking at in the Dow Jones, the same pattern that we're looking at in the DAX, which is the German stock market, the same pattern in the British, the FTSE, and the same pattern that we're having in France, the CAC. And if you look at Shanghai and you look at Hong Kong, you can forget that those folks have been in a bear market since 2006, and their rallies have been so pathetic. They're just unbelievable. This last one we did have a 786 off the previous yearly high, but 2006 they couldn't even make a 382 retracement. So those are the things that are happening in Asia that are not nearly as bullish. And remember, Asia was supposed to pull everybody out of this quagmire that we're in, and it's been basically the Fed, with their quantitative easing that has done this, and whether they come out and continue easing or they certainly can't drop interest rates below, well, they could drop interest rates below zero, but whether that will mean anything or not. We're going to cover bonds here, but I do want to get to one other commodity because it's affected by all of us. It's the hidden tax that we have, and that is the crude oil market. We've watched this for some time when we got down to that 85 level, which was the Gartley buy pattern, and then we pulled back to a 61% retracement at $91 a barrel. And now we've broken out to the upside, and we've gone above 97, and we're trading at above $98 a barrel right now, with a profit objective of at least 101, 102 per barrel, which will be the 786 of the whole range down from 2012 to the low we made in 2012. That would give us back to the 786 retracement up at that $2 per barrel. Now, if I am correct that we're getting ready to see a downturn in the economy, then it seems to me that probably crude oil would be starting to move lower as opposed to be going higher. This is something that we would have to let history decide whether it's going to be correct or not. But the charts, folks, there's no other way to look at it that they are just absolutely incredibly bearish, on a short-term or long-term basis. Anything that any way you want to look at it, they certainly look, very, very poor. That's the way it looks to me. The Fed has a big meeting coming up this Wednesday where they're going to be talking about, what they're going to be doing. And we've had a major completion of a big ABCD pattern in the Treasury bonds going back well over a year. It's retraced better than 78% of the move from March of last year to the high in July when we got to that 154 level. And now we're down into the 140 level, and we're having a little bit of a correction, to the upside here. We'll put this into Tiger TV so you can take a look at it. This is where I think the outlier event will be, folks, is that we're going to see higher interest rates, not lower interest rates. We're already starting to see them on a 4-week moving average. The price of mortgages have the 30 years approaching 4%. The 10-year notes are telling you that rates are going higher. So all of these things are coming together at the same time. And at the same time, we're having the U.S. dollar versus the euro and the yen and the British pound at really critical levels. So, again, we're looking at something really big getting ready to happen very, very soon, in my opinion, whether it's going to be triggered by, something like a lunar event. And we do have a full moon next Sunday on, June the 23rd. But that's about the only thing that looks foreboding. And I don't even know if that's foreboding because it could be a bottom or it could be a top. It's too early to tell because it's, 6 days out in the future. But that's something that could be getting ready to affect it. I expect a trend change at that day, but I don't know whether it'll be a high or a low. The good part about it is, boys and girls, nobody else knows either whether it'll be a high or a low. It's only a probability. It's never a certainty. So we will watch that on next Monday's show. We will have a pretty good idea. We had Arch Crawford from Crawford's Perspectives on last week. And Arch was very bearish, and he's looking for the market. Was looking for the market to rally into the June 26th Bradley aspect. That's 3 days after we have the full moon. So sometime early next week, if the market is still rallying, we have a 5-day rally here. We would be looking for the market to turn down. But frankly, I don't think we'll get a 5-day rally. This market's really bearish, folks. I don't see how it can possibly go up, but I get surprised a lot. Going to take a break. 877-927-6648.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pesavento, Andy Hecht, Victor Jones, or Terrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, we're in the 7th furlong of an 8 furlong race, so we've only got a little bit of time left. I wanted to mention something. Folks, if you ever go to Hong Kong, you think that it's an expensive city to buy a home, but for food and travel and entertainment and stuff, it is probably one of the best values in the world. For example, at McDonald's, right near where we live, which is off of in Tsim Sao Shui in Canton Road, one of the more popular McDonald's there, they have a breakfast of you get coffee, you get an egg over a hamburger, there's no bun, and then you get rice or macaroni along with that, and also a hash browns. That costs $2.11. That's U.S., which is $16.50 Hong Kong. The rate is 7.75. It's still pegged to the dollar. So food is and that's just, I'm not just saying McDonald's, but there's other places. They have Pizza Huts, Kentucky Fried Chickens, every place, all over. Plus they have all the usual local Chinese places that are very, very reasonable, too. You can go to the Ritz-Carlton and spend $200 or $300, of course, but if you want to just go to a regular place like most of us do when we're in the States, Hong Kong is a terrific place, for great value. Now that the Hong Kong Advisory have given me my commission for the month, we'll finish up with the gold and silver. Gold and silver are really trying to make a rally here, folks. Whether they're going to do it or not, I'm not sure. Gold's got to hold above $13.55 an ounce, and silver has to hold above $21 an ounce. Silver right now in the July is trading 21.75, and August gold is trading around 13.83. So they're you're about $3,000 away, $30 in the gold, and in silver you're about $3,500. There's been no really good indication from the commitment of traders or from looking at open interest or volume whether anything is happening in that market. I certainly don't see that at all happening at the present time. We're ending up the show here. I think the main thing to watch over the next few days is to watch this euro and watch this British pound, because I think we have a chance to really, have a turn here. We've certainly made some type of a bottom in corn. If you were able to get on that, I wish you the best of luck, because it started in the right direction. Now the risk would be very, very small, if nothing, in the corn, because it is in the time where you're going to have some bad weather in corn. We're going to cover this on the Thursday show for commodities, but those are the main things. The euro primarily, secondarily the British pound. Those are the ones stocks, I think you just sell them on rallies. I mean, how much of a rally we're going to get, I don't know, but if we even make a 61% retracement, which would take us up around the 1657 level in the S&P, I would certainly take a look at that. But whether that happens today or not, it's more than 20 points away, and it's already up 20. So chances of it moving 40 in one day would be an outlier event, but that's certainly possible. I think the main thing for today's show to focus on are three things, and that's the euro first, the British pound, and the corn. Those are the three that I think look the best for trading opportunities for the week. I would love to see the Treasury bonds rally around 4 points, in the September bonds, getting them up around that 145 area, and that would really be a good place, I think, to put the short on. We've got the Fed coming in, I believe, on Wednesday. So there's going to be a great deal of things happening as far as announcements and rumors and interpretations of rumors and all the other things. That's it, folks. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.